The Trump administration has made it clear that they're trying to push the U.S. economy into a recession. But that doesn't mean it's not going to be volatile. That doesn't mean that Tesla cannot rally in the meantime. I actually think this week could be a good setup for a tactical rally in Tesla. And I will share with you your big economic data sets, CPI, PPI, Michigan consumer sentiment, job openings, and more, and why I think this week could actually be good for markets. Obviously not a guarantee, but could be good for markets. Now, I will say that tomorrow may not be a good day. You could see Bitcoin is down about $4,000 in the last couple of hours, really following some comments by Trump. And this could be a leading indicator of what to expect from markets. Now, what Trump said today that is really spooking Bitcoin is what we talked about in the last video. I will reiterate it here in this video as well. He reiterated the April 2nd reciprocal tariffs, and he says that tariffs may actually go up over time. He says, quote, the tariffs could go up as time goes by, and they may go up. And, I don't know if it's predictability. So not only do we have tariffs that are already, put into place, that more are coming into place, he says the existing tariffs could go up over time. So it's really just creating more uncertainty. And there's no way to really forecast this because tariffs are all on a president's, discretion. So it could happen at a moment's notice. And that kind of spooks investors. But I also think it was Trump's comments about a recession. Trump basically confirmed we're going into a recession. Trump was asked about Atlanta Fed's warning of an economic contraction in the first quarter of the year. Trump seemingly acknowledged that his plans could affect U.S. growth. Still, he claimed it would ultimately be great for us. So Trump is willing to sacrifice the economy for his agenda, which, for better or for worse, it's like, do we just get it over with now? Do we rip the Band-Aid off now and cause this recession and then get back to business as usual? Bring down 10-year Treasury yields. Scott Bessent, Trump, they've been adamant that they're going to bring down 10-year Treasury yields. A lot of people just didn't think it would be because of a recession. And that's what it's starting to look like to me. I mean, whether it's Challenger job cuts coming in at, 08, 09 recession peak levels, or 2001, 2002 recession levels, or it's personal spending that's negative, or retail sales that are negative, or overall consumers starting to slow down, there are signs out there that things are getting worse. So tomorrow could be a rough day for markets, but I do think if the data does what I think it'll do this week, you could actually see the markets go through a little bit of a bounce, because I do think inflation could come in lower than expected. Now, here in this upcoming week, starting off tomorrow morning, you will get consumer inflation expectations. You're expecting 1-year inflation expectations at 3.2% coming tomorrow morning. Again, just be mindful of the political affiliation there. Democrats expect a lot of inflation. Republicans expect no inflation. Independents are at like 3%. Right? So just be mindful of that. But that's pretty much all we have for tomorrow. On Tuesday, you have JOLTS job openings. Now, if this thing plummets on Tuesday, that's going to be something to really pay attention to, because, if you're doing good and you're a small business, you're looking to hire 5 employees, that's great. The next month, let's say you're only looking to hire 2 employees, that's a red flag that things could be slowing down broadly. So less job openings, likely weaker the economy. More job openings is a good sign. So that's what we have for Tuesday. That's your big data. Wednesday, you have CPI. You're expecting month over month at 0.3%. This one's pretty, again, self-explanatory. If you have good numbers, good CPI, low CPI, that's good. If you have high CPI, that's bad. But also, like a too low of a number, like China just had negative inflation over this weekend. negative 0.7% year over year CPI, that's also not going to be a great sign for economic activity. Now, the expectation is 0.3%, so expectations are high, and I think there's a good chance we come in lower than that for the month of February. Year over year is expected at 3.2% to move lower than last month's 3.3% reading. Headline month over month expected at 0.3%. Year over year headline expected at 2.9%. So I think across the board, you could probably come in with lower CPI, and that could help give us a little bit of a bounce, okay? Would not surprise me at all if CPI is lower and markets react favorably to that. Now, if it comes in high, then you're looking at stagflation, and that's obviously not good. On Thursday, you will get PPI month over month and initial jobless claims. Lots of smaller data comes out as well. PPI excluding food, energy, and trade month over month. A lot of smaller data points as well. 30-year bond auction as well on Thursday. On Friday, you're going to get the Michigan Consumer Sentiment Survey, expecting the headline number to fall from 64.7 last month down to 64. What has caught people's attention recently is the rise in 5-year inflation expectations and 1-year inflation expectations. But this survey is very political. Again, Democrats expect almost hyperinflation. 7% of respondents to this survey think we're at inflation levels over 25%. Like, there's a huge political element to the survey. But last month, you've seen a big rise, highest levels of 5-year inflation expectations since 1995. And you're expecting that's going to move higher from 3.5% to 3.6%. So that is a little problematic if that happens again. Consumer expectations are expected to fall as well. Current conditions also expected to fall. And 1-year inflation expectations expected to rise from 4.3% to 4.4%. And I think that is going to be something the markets pay a lot of attention to, because that rise in 5-year inflation expectations and 1-year inflation expectations did spook the markets last month. Now, we do still have a lot of earnings that are still going to be coming out this week, Monday and after hours. So tomorrow and after hours, you have Oracle and Asana, as well as Vail Resorts and some others. Tuesday pre-market, Kohl's, Dick's Sporting Goods, Ferguson. Tuesday and after hours, Casey's and some other names. Wednesday pre-market, you have Zim, iRobot, some other names. Wednesday and after hours, Adobe, UiPath, Centennial One, American Eagle Outfitters, some smaller companies as well. Thursday, you have Dollar General, Futu. Thursday and after hours, you have DocuSign, Alta, Semtech, and then Friday, couple of other names. There's a lot of smaller cap companies that are still going to be reporting this week and even over the next couple of weeks. But some big ones like Dollar General, Alta, DocuSign, Adobe, UiPath for what it's worth, Oracle, Asana, right, Dick's Sporting Goods. These are going to be companies that Wall Street pays attention to, especially some of your retailers like Dollar General. I think is going to be really important to see, are consumers continuing to spend money? Alta, same thing there. Could they be vulnerable for a consumer that is slowing down? Potentially. And that's something Wall Street's going to pay attention to. Now, the CNN Fear and Greed Index today is at 20, which is a little bit better than where it was previously at 17. And overall, I think you could be due for a bounce in markets, a further bounce in markets. But I think it will be sold off as the economy continues to look like it's heading closer to a recession. The percent of stocks trading above their 50-day moving average is at 31.35. So you're still very bearish from that measure as well. And bullish investors are at lows we have not seen in many years, coming in at 19.3% of investors that are bullish, 23.6% that are neutral, and 57.1% that are bearish. So like the last 2 weeks, sentiment is absolutely terrible. And that is one reason as well I think markets could bounce here, because people are so bearish. And lately, the last couple of years, people have been quick to buy the dip in markets. But I don't think that is the right thing to do. When the administration is telling you they're going to push us into a recession, and the Fed's telling you they're not in a rush to help markets, it's not a great dynamic for stocks when the S&P is only down about 7% from all-time highs. Like, that is not an ideal setup. And unfortunately, you can see in a stock like Tesla that's down almost 50% from all-time highs, there is some recession risk priced into Tesla. There's some recession risk priced into Palantir. There's some recession risk priced into, some of your other high-flying, quote-unquote, momentum stocks. Those are the first areas that go during a slowdown, right? In 2021, from really July until November, momentum stocks started to peak out. But the S&P did not hit a new all-time high until the first week of 2022. This happens first before the broader markets roll over, before your Apples and, other more quality stocks roll over. You've already seen the start of this. Now, SMH, this is the semiconductor ETF. This thing is flashing a major warning sign to us. Now, well below its 200-day moving average. In fact, you are below your 200-day moving average by about 8.4%. The last time you were below your 200-day moving average was 2023. And really, you were below this throughout all of 2022, right? The last time you fell below your 200-day moving average, the semiconductor ETF fell 37%, and you fell below this in January of 2022. That was a big red flag that more downside was coming. And investors are in no rush to go out and, buy this ETF. And semiconductors are cyclical historically in nature, right? They go through booms, they go through bust. When the economy is good, semiconductors do good. When the economy is bad or you go into, recessions, it's one of the last places investors want to be, right? Like autos or restaurants during recessions. Semiconductors can also be put in that category. So there's a lot of red flags out there. I don't like headline markets down 7% with the administration basically saying we're going to go into a quote unquote detox. Trump saying, yeah, I don't care. We're going to follow through with tariffs. We're going to continue on the path. If the economy, if the cost of that is the economy, fine. And really what I think it is they're trying to reset interest rates. They're trying to kill inflation. The fastest way to do that is a recession. Now, you may think that you're able to slow down or stop a recession, but once a recession starts, it's impossible to have a shallow one, right? To just engineer the start and stop a recession. It's impossible. It's a self-fulfilling, feedback loop. Businesses, they're not bringing in as much money because people are not spending as much. They lay people off. Now those people can't spend, and businesses have, even less money coming in, so more layoff, and it's the cycle, right? And that's what's dangerous about right now, and I think the broader markets, because we are up a lot. We're not pricing in that recession risk yet in the S&P, but there's recession risk being priced in other areas. It's really just a matter of time before that recession risk gets priced into the headline S&P. But I do think it's going to look a lot like 2022 in the sense of you fall, then you rally. You fall further, then you rally. You fall further, you rally, right? It's not going to be straight down. And what we've seen really lately is straight down. Could you need maybe another leg down before you rally? Potentially we get that on Monday. We'll have to see. But I think from a sentiment perspective, you could be due for a bounce and then, probably come back down. Part of the problem is, though, with that, you're already up from the low of the day on Friday, like almost 2%. So you've already seen like a 2% bounce, even though it really doesn't feel like it, which, who knows? We'll see. 200-day moving average sitting at about 569.54. That is a level we want to watch to see if we find support there. Because the last time the S&P was at your 200-day moving average was back here in October of 2023. You bounced after you fell a couple days below that. Before that, though, the last time you were at your 200-day moving average or really below this was between November of 2022 and the ultimate, bottoming process that we went in and April or March of 2023, right? As we were coming out of 2022, you broke above your 200-day moving average and really never retested that again besides right here, November 2023. You had a few days you were below that. So it's a very important level from a technical perspective, and a break lower this week would be a negative sign. But don't be surprised if we can bounce a little bit, potentially even back to that 585, maybe 590 level on the SPY before what I believe will be another leg down. Now, I do think you can be selectively buying here, and hopefully this video does not come off as, sell everything. That's clearly not what I'm saying. I think there are opportunities out here. I think, again, for a stock like Tesla, who knows if we go into recession? The stock's down almost 50%. Every time the stock has fallen this much, it has been a long-term, great buying opportunity. And I don't think this time is going to be any different. And in the odd chance that Trump backs down on tariffs or something along those lines, then, I think the stock could bounce a lot, right? Stock could go back to new all-time highs fairly shortly if, the tariffs were to stop and Doge cuts were to slow down a little bit, then that would be good. But at this point, I really don't think that's going to happen, okay? And for anyone that is curious why a recession now is starting to grow in probabilities, is because you have Doge that is making 2 million government employees really on edge, slowing down spending. But you also have Doge that is cutting a lot of the fraud, waste, abuse, whatever you want to call it, which, that's great long-term for the country. In the short term, that means, a lot of government contractors no longer have that work, and there's less hiring, there's less confidence around, millions and millions of people that rely on that government, funny money, if you will. So I think that is a big issue for confidence in the consumer. You also have tariffs. From a business perspective, until you get clarity on policy, you're going to slow down your investments. You're really going to slow down hiring. Okay. You wouldn't want to hire in this environment. So I think you mix those two things together with a Fed that is not, rushing to help the markets, and you have a recession catalyst. Okay, part of the reason why I've been this anti-recession on this anti-recession narrative for a long time is because we just didn't have a catalyst to push us into recession, even when the economy was looking weak. And we've had moments where the economy has looked weak. There hasn't been a catalyst. And now with Doge, government, austerity, and a real plummeting in confidence with consumers, this could be a catalyst to push us into a recession. And you're already seeing, really bad Atlanta Fed GDP numbers. I'm sure they're going to bounce up a little bit, but could Q1 be negative? Perhaps. You're already seeing recession risk priced into some stocks out there, like Tesla, and it's not priced in the headline S&P. So there's two people watching this video. There's one person that's going to be angry, one group of people that's going to be angry and call me names and all that. There's going to be the other group that sees the opportunity and the value provided. As the markets are down 7%, if we can understand that recession risks are rising, the opportunity is rising. Recessions make more millionaires than lottery winners times 10. Okay. If you understand that this is an opportunity, you could do very well here. Now, what I am doing is buying calls on TLT, May, June, July, later than that, giving it some time, of course, but that's what I'm doing. If you guys want to come see the trades that I am making in real time when I make them, check out the link down below in the description of this video. And I'm going to be making a lot more of those trades in this upcoming week. I'm also going to be trading some of these earnings this week. I think there could be some big movers. But again, come join that if you guys want to talk to me and get access to all of the information over there. We also have a newswire as well, which is very helpful in these times of volatility. But bottom line, you could see this as an opportunity or you could be a hater. It's your choice. Okay. If we do continue to slip into a more recession narrative, which I think is going to happen, markets are going to fall further and your buying opportunity is really going to arise, right? Now, I'm buying Tesla here. I think the stock could fall further, but if I'm wrong, I want to have exposure. And I'm not selling stocks that, I don't want to hold for a long time. My long-term stocks are not being touched here. If there's stocks that I was just trading or, I don't want to hold for 10 years, yeah, maybe I'm getting rid of those. Okay. But this is an opportunity, especially if we do see a lot more downside, which is possible in markets as a recession does become more obvious. You're going to have buying opportunities like maybe 2022. And if you did not maybe position the best for 2022, you could have another opportunity, which doesn't normally happen this fast, right? 2022 was only a couple of years ago. So that's kind of what I'm doing. Calls on TLT, positioning for further downside. If we do get a bounce in markets like the SPY, I think puts could also be a way to hedge portfolios. But the options are really expensive. So I think you need to see a bounce before going into those. And I think that could happen this week. And that's kind of how I'm looking to hedge my portfolio, to position for that downside. And, hopefully all things work out. But, the backdrop that we have in the economy right now doesn't look good. Administration's trying to push you into recession. Fed's not helping. Yeah, 7% down in the S&P does not seem appropriate for that backdrop. So let me know your thoughts on this down below in the comment section. Could Tesla rally? Could markets go through a rally this week? Of course. I'm not saying markets are going to fall 25% tomorrow. Clearly not. This is going to take some time. This could take months. And that's why I've said for, weeks now, raise cash, pay down margin, get ready to margin when, the markets really do hit the fan. Right. And that's not financial advice. Margin's not for everyone. Contact a financial advisor if you don't understand what I'm saying in this video. None of this is financial advice. Do what you guys want. I'm just documenting what I'm doing. And Tesla could bounce, right? Tesla could be a $300 stock by midweek if CPI comes in good. But, do we ultimately fall further? Probably before all things are said and done. And, I really think there's a lot more downside for the broader markets versus Tesla. But again, that's why I'm buying 2 shares, 3 shares, 5 shares at a time in Tesla, averaging my way in as the stock continues to fall. So let me know what you guys think about this down below in the comment section. Again, if you guys want to come trade with me live in real time, every time I make a trade, I send out alerts. There's a newswire over there. Come join the community. Come get involved with the conversation. Link down below in the description of this video. Have a fantastic rest of your day. Stay safe out there, and I will see you in the next one.